Hey, what's going on, everyone? I know today is going to be a little bit of a different type of video. However, I just had to let you guys know about Michael Burry and what has been going on with his portfolio because this really does add a lot of perspective as to where this market could be heading in his opinion, right? I'm going to try to limit my opinions as much as possible because this is a video about him and his portfolio just to give a little bit of more insight as to where we could be heading for 2022, which a lot of people right now, they are very bearish, a lot of negative sentiments. And again, I'm not going to add mine because this is a video about Michael Burry. So let's get started. So Michael Burry of The Big Short sells just about everything and adds Lockheed Martin. Now take a look at this, everyone. The famed investor's public positions down from 22 securities to just 6. So that's extremely important because he used to have 22 securities. We don't know exactly what these positions were. However, he just limited down to now 6. What does this tell us and what is he trying to do? How is he trying to sort of strategize his portfolio, right? And so he also closed bearish bets on bonds, but public commentary suggests that the positions may have been moved to a non-reporting derivative. This is also very important because it states non-reporting. Now let's go a little bit lower because I believe it does discuss a little bit about the positions. And here it is, everyone. Look at how concentrated his equities are right now. He has stocks like CVS, and we can see over here 200,000 shares. We have stocks like Now, Lockheed Martin, which is stated in the beginning, CVS as I just stated, and you can see there are so many shares over here, and that really does equate to a lot in the dollar amount. And right off the bat, I'm going to be guessing that these are companies that have a solid balance sheet. They have a solid growth to it. They have probably a lot of guidance going for them too. Even in 2022, if there is talks about tapering, I think that these companies, especially when I see CVS, I think these are the ones that will not be affected that much. And then over here, we also see some more contentions between Michael Burry and Elon Musk yet again. So again, Michael Burry spars with Elon Musk over Rivian's true test in his second Twitter spat with Tesla CEO this week. So I'm not going to read all of this, but I am just going to mention 2 points that he does make. So right over here, very quickly, Elon Musk tweeted that the true test is whether Rivian can achieve high production and break-even cash flow. And then Burry tweeted back and replied, "No, Elon Musk, the true test is achieving that without massive government and electricity subsidies on the back of taxpayers who do not own your car." Burry later deleted the tweet, something he's known for doing. And then if we also go back down, we see over here, in another tweet on Wednesday, Burry said Tesla stock could plunge 90% like Amazon did when the 90s dot-com bubble burst. Quote unquote, Amazon fell 95% 2 decades ago, changed its whole business, and thrived much later, he wrote in a now deleted tweet as well. And before you guys hear what Michael Burry is saying right now, I want to pull up some charts real quick just to discuss why Michael Burry may be doing what he is doing and just offer some more insights and perspectives as I stated in the beginning of the video. So a lot of people right now, and again, I'm even going to be allowing you guys to hear other people's perspectives on what stocks will probably do the best in 2022 because right now many people are worried, is there going to be a crash? Has there already been a crash and we just don't know about it, right? What is really going on? So the S&P 500 collection of the best 500 companies, this index fund has already started to go down quite a lot from the highs of $470 all the way to a lows of about $448. Let's just round this to $450. Now people are trying to do right now, or at least this is what it seems like, is they're concentrating specifically on few equities, just like how Michael Burry did. And I'm not going to again offer my insights as to whether I think this is right or wrong, but I am just saying this is what people have been doing. And we did see with Michael Burry how he limited his positions from 22 to just 6. And this is because companies back then that used to be very good, now they just do not have that same growth story behind it because their balance sheet does not convey the signal that many people want for the year again of 2022. And by the way, this is DocuSign going all the way yesterday from 200 about $30 a share all the way to $135 a share. Yes, this is a gap down, and no, this is not uncommon at this point in time. And again, that is why many people are confused. Has there already been a market crash? And let's just hear what Michael Burry has to say about some of this right now.
Now he's betting against Kathy Wood's ARK Innovation Fund. And Akiko, this is a fund that we've talked about here quite a bit. It had a huge run up last year and into the beginning of this year, but is off considerably from its highs, I think about 25%, down to 7.5% for the year. And he's done this through the options market and basically controls about 235,000 contracts. And we don't know the exact strike price. And here we have a heat map showing ARK Innovation ETF holdings. And these are just some of the top holdings here. I will go to a year-to-date look here, and you can see kind of a mixed bag. Over the last 6 months, I think this is when it gets the most dark red. Teladoc down 50%. So are some of these other names. Spotify down 41%, Roku 22%. Over the last 3 months, guess what? These holdings have come back, but I don't know, Kiko. What's your take on this?
Well, Kathy Wood has become controversial, if you want to use that word, because of some of the lots of valuations that she has put on these big growth stocks. And of course, anytime you hear Michael Burry make a bet, people are going to listen because of his history. What I think is interesting is how this has kind of been aired out. And I want to point to a specific tweet here because Kathy Wood has taken to Twitter to respond specifically to Michael Burry, saying, to his credit, Michael has made a great call based on fundamentals and recognized the calamity brewing in the housing mortgage market. But I do not believe that he understands the fundamentals that are creating explosive growth and investment opportunities in the innovation space. And it comes back to the valuation argument, Jared, because when you think about Kathy Wood, the big investments she's made on the likes of Tesla, she has always said this is a long-term play. It is about the potential, the faith in these companies to build up these big innovative ideas. And some would argue that valuation just hasn't been proven, hasn't played out necessarily. Is interesting that, and by the way, we're just reading one tweet here, Jared, but there is a very
There are
long
many.
thread that she has put out in
I'm
response.
Yeah, I'm glad you mentioned that long thread. I went through the entire thing, and I think I understand her mentality a little bit more. And I find her brilliant. We've interviewed her many times over the years. I think some of her recent comments about cash stocks are a little bit dangerous, but overall, I give her a lot of credit. And so you look at the disruption that's going to be taking place in automotive, or just let's call it mobility, the robo taxis. We're not going to really see valuations. Well, we're seeing the valuations now. We're not going to see the rubber hit the road and that technology really being proven until you start moving the macro needles. So once you start actually reshaping society, and once all these wonderful inventions that we're just kind of talking about, once they litter the highways, then I think we'll see this. I think we'll see why people were betting on companies like Tesla and some of these gene therapy companies like CRISPR and all different fields. So I believe in her investment thesis. I think I'd like to be a little bit better at risk management, but I think I get it.
Yeah, and as you said, Jared, off camera, it is faith-based.
Yeah.
If you look at where these companies are headed, it's not about a 5-year plan, a 10-year plan. It's about a 20, 30-year plan. And if you believe that the future is in autonomous driving, in EVs, this grand vision that Elon Musk has put out, for example, with Tesla, then you put your money behind the company. But interesting that she has felt the need to come out and tweet this, because I think she's been under a bit of pressure given the performance of specifically ARK's innovation ETF so far this year.
I think so. And we've seen where faith-based investing can be taken to an extreme with Archegos. Bill Wang was worth $30 billion one day, a couple days later, worth zero. So we've seen that taken to extremes here. But all in all, I'm quite impressed with her portfolio. It's just been in a slump.
Yeah, I think so. I don't like the word defensive so much. I like the idea of quality. And what we've seen in the last year was a rally off the bottom when all of the lowest quality stocks ran well above the high quality stocks. So I'm talking about companies with a lot of debt. I'm talking about companies with very low profitability. I'm talking about companies that have a lot of volatility in their cash flow streams. Those were the ones that led from, let's say, November of last year through the summer. But things have begun to change. And now these higher quality stocks are holding up much better. So in the last month, when the market has come under this pressure, high quality stocks, as we define it at Washington Crossing, are down only about 1/3 of what low quality stocks are. So we think move up to these higher quality names, you can still get growth, you can still see returns, but the market is going to be more challenged here given all of the risks that we just discussed.
Are we in a correction? Is that what you feel? Is that what it feels like to you?
It very well could be. What we put it in context. Before the pandemic began, we had a market in the United States worth just a little over $30 trillion, which was a pretty rich valuation then. Today, that valuation is a little over $50 trillion, only having come down $1 trillion or so in valuation terms from the high. So we're still looking at a market that's fairly rich that is now going to come into a period where there's going to be less robust policy support. And you throw on top of that some question marks, I guess, about the growth outlook. Our position at Washington Crossing has been to lighten up on riskier assets, lighten up on stocks relative to bonds. We've done this over the last 4 months or so in our tactical asset allocation portfolios, by the way. And we think that we might be in for a period of backing and filling as the market digests what has been a historic run in terms of valuation creation.